Will Powell feel the political pressure?
Well, the Fed, of course, always says we're not political. We do
Right.
what we're supposed to do. We follow the models. We're not political at all. That's completely untrue. They're highly political. They watch the headlines very closely. Um, so they're aware of it. And you have to sort of put Jay Powell in context. He is a Republican, but he's a Bush Republican. There's no reason to think he likes Donald Trump or is a Trump supporter, et cetera. He's not a Democrat, but he's the kind of Republican who doesn't really like Donald Trump. So my expectation is, the Fed for now is not going to cut interest rates. They're done raising. That's pretty clear. You'd have to have some kind of inflation shock before they raise rates. That is unlikely to happen. Prices are going down. Well, sorry, the rate of inflation is going down. Prices are still going up. That's a very that's a big point of confusion. So prices are going up, but the rate of increase has dropped from 9% to 3% in the past 16 months. So that's progress. 3% is still well above the Fed's target of 2%, but they think they're at what they call the terminal rate. The terminal rate is the rate where it's high enough to bring inflation down without having to raise rates more. In other words, it's high enough to act as a brake. Just give it time, and inflation will come down on its own without further rate hikes. The Fed believes they're in that position. They won't be raising rates. So the question is, when will they cut rates? The answer is when it's too late. Meaning, the Fed are usually the last to know. And the best example I can give you, Danielle, is they pay enormous attention to what we just talked about, the unemployment rate. 3.7%. That's one of the lowest unemployment rates since the 1960s. I mean, it is extremely low. But they believe in this Phillips curve, and the Phillips curve is an inverse relationship between inflation and unemployment. So the view is if unemployment's low, inflation is going to get a little higher. If unemployment goes up, inflation goes down. So they're saying unemployment extremely low, and saying, well, that's a little bit of a danger in terms of inflation. So we can't cut rates. But in fact, there are a lot of problems with that. First of all, there's no evidence for the Phillips curve. I mean, I can give you, to do a quad chart, I can show you high unemployment, high inflation in the late 1970s. I can show you low unemployment, low inflation, in the mid 2010s, and so forth. So you can find every low unemployment and low inflation during the Great Depression. So there is no Phillips curve, or you construct it. The Phillips curve, last time I looked, was a flat line, not much of a curve. So first of all, the Phillips curve is garbage. Secondly, employment is a lagging indicator. I'm not saying it's an unimportant number, but employers do everything possible to avoid laying people off. When revenues are drying up and margins are going down and profits are going down, they'll turn out the lights. They'll renegotiate the lease. They'll cut the laundry bill. They'll bargain harder with suppliers. They'll do everything they can except fire people, because people are hard to hire. You get the talent, it's hard to find. You train it, the last thing you want to do is fire them. So they will fire them. Unemployment will go up when they get desperate enough. But by then, the recession has already started. In other words, it's a lagging indicator that tells you nothing. So my point being, Jay Powell is looking at lagging indicators. If unemployment starts to go up, which I expect it will, he will cut rates. But we will already be in the recession. So he'll have political insurance, because he'll say, well, yeah, we're cutting rates, but hey, we're in a recession, we have to. It'll help him avoid the charge that he's doing it to help Biden. I mean, it's the charge will be made anyway. They'll be in the political crossfire, but the economy will be so bad at that point, no one's going to blame Jay Powell. First of all, that's what history shows, and none of these things are completely deterministic. But financial history can be a pretty good guide. And you go back to 1998, 1997, 1998. What happened? Just very briefly, that crisis started. It came to a head in September 1998 with long-term capital management and the Russian default. But it started in Thailand in June 1997 when they closed the capital account and devalued the Thai baht. And that started a panic throughout Asia, because everyone assumed that all these pegs to the dollar were safe and you could put dollars into Thailand and Indonesia and so forth and not have to worry about the exchange rate. And all of a sudden there was a run on the bank. I talked to Dr. Mahathir was the prime minister of Malaysia about this. He was the only guy who kind of got it right. But once Thai did that, then there was a sequential collapse, bank run, if you will, in Indonesia, South Korea, Malaysia, et cetera, throughout Southeast Asia. But then it calmed down in the winter by December, but it was very serious in the fall. I mean, people were getting killed in the streets in South Korea. But by December 97, January 98, February 98, it had died down. It looked like it was over. And I was at Long-Term Capital Management. We weren't worried about it. We were looking at expanding our business in Asia. And, we actually paid a $3 billion all-cash dividend in December of 97. And that's how confident we were. We gave $3 billion back to our investors. But then by April, it started to hot up again, and then the Russian default was in August, and the LTCM meltdown was in September. So that had two stages, but a quiet period in between. Same thing in 2007, 2008, the global financial crisis. That really took off in the spring of 07 with the mortgage losses, and then we all remember Jim Cramer's they know nothing. They know nothing. But then it died down in the winter. But it came back with Bear Stearns. So these things do have two stages. We're in a quiet stage right now, but I expect the banking crisis will return. Well, we have so far, but I think our luck has run out, if you want to put it that way. Germany's in recession. They just are. That data is clear, and it's getting worse. Japan is kind of right on the edge, might be in recession. UK, same thing, right on the edge. The U.S. China, saying China's in recession is probably a stretch. But if in China, if the growth goes from 10% to 7% to 5% to 4%, which it has over the last 10 years, that lost output is equivalent to a recession. China's trying to prop up their economy, so their economy is doing very poorly. When I see things like world trade contracting, it's not with the trade figures. Everyone focuses on surplus or deficit. So you have a trade surplus, your GDP goes up. You have a trade deficit, your GDP goes down. Or do the deficit shrink? That makes GDP a little higher, et cetera. Forget about that. I mean, yeah, okay, it's important data, but if you look at the top line, the exports and the imports, they're both shrinking. So whether the deficit gets a little bigger or a little smaller is less compelling, less important than the fact that both numbers are going down. World trade is shrinking, and that almost never happens except in recessions or during the Great Depression. You have the gold for the day when the dollar's not worth anything. That's why you have the gold, and everyone's going to be saying, "Get me some gold." So that's number one. Number two, tell me the use case for Bitcoin. I mean, there is no use case as a form of speculation, as a form of gambling. Yeah, it's the chip in the casino. I'll grant that. I understand, but people tell me, "Oh, Jim, you're technophobic. You don't understand." I read Nakamoto's paper in 2009 when it came out. Okay, I've been in gold Bitcoin debates since 2010. I never lost, by the way. Yes. So I get it. I get the technology. I get the math, but I also understand monetary economics. And there is no use case for Bitcoin except for entertainment.
Is 2024 the year for gold? I know for you it's all years, but a lot of people coming out with the fact that this is the year.
Well, the answer is yes, and I'll tell you why. Because there are a number of factors that drive the price of gold, and you know them. But just for the benefit of the viewers, you start with supply and demand. Supply has been constant. Global mining output hasn't gone up or down very much for about 6 years. It's pretty flat. Demand is going up. Not because of retail, Americans don't understand it, but central banks do. And Russia, China, Mexico, Kazakhstan, Vietnam, a long list of central banks have been acquiring gold. By the way, they're acquiring more gold now because this whole treasury bill confiscation we talked about earlier. So when demand is up and supply is flat, that tends to drive prices higher. So that's a good start. But the biggest factor driving gold prices recently is declining interest rates. So if you said, "Jim, give me your forecast for gold," I would say, well, let's start with the forecast for interest rates. And the forecast for interest rates is they're going to drop a lot, very steeply. They already have. The yield to maturity on the 10-year note dropped from 5% to 4% in like the blink of an eye. It was like a couple of weeks in November and December. Now it's backed up a little bit. Nothing goes in a straight line. We know that. So the past couple of days, well, a week or so, the yield is kind of backed up from 3.85 to 4, but that's temporary. It's going to go to 2 or lower, because now we're back to the recession. You get the kind of recession and disinflation and even deflation that I see that we're talking about, then interest rates are going to come down a lot. So I would look for the yield to maturity on the 10-year note to drop from 4 to 3 to the 2 handle, and that's going to send the price of gold a lot higher.